Interest rates have skyrocketed to levels that we haven't seen in 20 years, causing a shift in our real estate market that's got home buyers ghosting real estate and creating demand levels lower than we've seen since the housing bubble years. But does that mean that we're going to have housing prices crash like they did during the housing bubble crash? Minnesota homeowners, home buyers, and realtors. It's eXp Realtor David Garvis coming to you, and we have 10 months of real estate data to help answer that question. So let's put Data Dave to work, give you a quick update on the market and what to expect in the future. But if you like videos like this and you want to know the good, the bad, and the ugly in our market as soon as it happens, subscribe and like or comment this video, and we'll be sure to let you know what's happening when it happens. But for now, let's get Data Dave to work, have him tell you what's happening today in our real estate market. We'll use current market data compared to the bubble years to see how imminent home price crashes might be. But first, let's update today's data, because while Halloween is over, the buyer demand numbers are scary. With just over 4,000 sales in October, we saw record declines, down about 33% from a year ago and leaving us off about 15% for the year. As the market shift has buyers ghosting a home purchase like a bad Tinder date, which means if you're considering selling your home, you can no longer expect 10 or more offers within days of a home hitting the market. But because you subscribe to this channel, you know demand is only half the equation. And we see this shift is also making home sellers vanish. With only 5,000 homes hitting the market, our supply was down 20% compared to a year ago and leaves us off nearly 10% on the year. Meaning home buyers still aren't seeing an influx of homes to consider, just less competition to buy what's there. And with supply declines balancing the drop in demand a bit, our magic ball number remains at a seller's market level of 1.9 months. But that number is trending up, and up significantly from the all-time lows we saw earlier this year. For now, though, that seller's market number continues to push our home prices up nearly 5% compared to last year, with the median sales price of $356,000, and leaves us up over 7% for the year. But will this market shift create a home price crash like we had in the bubble years? Let's dig in and compare this market to the years leading into the last crash by comparing three very important questions. And data is always a great place to start. So if we compare demand during the bubble years to today's market, it's really similar, dropping each of the last 2 years at a similar rate. But look at supply and the actual homes on the market during the bubble years. We see increases each year leading into the bubble popping, and we already know our supply is not increasing. But gang, look at how our active inventory compares to the bubble years. We are over 400% lower than that time. So for now, the check mark for current market goes to no. Next, let's review the type of loans used. Have we shifted to a risky loans to help create demand? We do see similarities between current market and the bubble years, and that both use conventional FHA or VA products and some ARM loans to get home buyers into homes. But gang, when it comes to 100% financing, stated income, and seller paid down payment programs, they just aren't out there in today's market, and very common during the bubble years when programs lowered lending standards to make it easy for just about anyone to qualify for a home loan. And Data Dave loves charts, so if we look at the MBA chart for mortgage availability, we absolutely see how difficult it is to get a loan today compared to the bubble years. And there's been some buzz about buy-down programs, assumable and contract for deeds, which aren't really used much today or during the bubble years, but could become common in the near future, and we talk about on our Mortgage Talk Monday videos. But when it comes to risky loans, the check mark for today's market is a solid no. And finally, let's compare the value of owning the home itself. And of course, we'll begin by looking at home prices, where we see for the 3 years leading into the bubble burst, home prices actually dropped, which left homeowners, many of whom purchased with no down payment, with less equity in the home than when they purchased it. But our current last 3 years, we've seen prices increase each year, leaving homeowners with solid equity. But that's not the only value most homeowners realize today. As you look at interest rates, homeowners leading into the bubble felt no value in the interest rate they had on their home loan as rates actually got lower. But we know what's happening in our market lately, as it's very difficult to give up a 30-year loan originated over the last 2 years, which is why our supply will continue to remain low and why today there's so much more value in home ownership than the bubble years. So price increases are decelerating, gang, but no price crash ahead for the next quarter at least. But there are some data points trending up which will require a close eye. Make sure you subscribe and like or comment this video, and Data Dave will be sure to keep you updated with everything that happens in our market before it actually happens.